Hi, welcome to Finivize. Federal regulators are preparing to seize control of First Republic Bank. According to multiple reports, the bank appears to be on the verge of collapsing. We are all hoping things would get better within the US financial sector, but it seems this is just the beginning of the big doom. Come to think of it, at the end of 2022, First Republic Bank was classified as the 14th largest commercial bank in the US. And just in a matter of months, the bank is shaking to its root. That's unbelievable. First Republic is a regional bank mainly financed by wealthy clients, rich private firms, and billionaires. The bank has been struggling to survive ever since similar institutions like Silicon Valley Bank and the Signature Bank collapsed in March, raising huge fear and panic among everyone about the stability of all other banks, both small and mid-sized. What exactly is going on? For now, there is limited information except for the alarming drop in the bank's stock price by 93%. Exactly, that's how much First Republic stock has crashed since March 1st. Initially, the government repeatedly said there were no major red flags about the health of the financial sector, and no signs that the nation's largest banks were in distress. In fact, First Bank appeared to be back on the right track last month after the four biggest banks, JP Chase, Bank of America, Citigroup, and Wells Fargo, each made $5 billion deposits, leading to a brief stock recovery. Even at that, concerns about the bank's stability persisted and significantly worsened this week after the bank disclosed it only received $104.5 billion in deposits during the first quarter. That's about a 41% decline compared to its usual output in the first quarter of last year. That was far below the projections of $136.7 billion in deposits. Shares of First Republic sank to their lowest price ever on Tuesday afternoon after the struggling bank's disclosure, thus compelling investors to sell off immediately. The share price declined even more by 43% on Friday, 21st of April, bringing it to a close at $3.51 for the week. As reported by Reuters, the U.S. Federal Deposit Insurance Corporation, FDIC, is preparing to place First Republic under receivership as the greatest financial crisis since 2008 continues to hit mid-sized U.S. banks. Next to the failure of Silicon Valley Bank and Signature in March, the California-based bank might probably be the third huge financial institution to collapse this year. After the huge Friday loss, the bank revealed another shocking news, the most shocking report ever. The bank revealed on Monday 24th that it had lost $100 billion in deposits during last month's banking crisis. No one was expecting that. It came as a huge shock to many Americans and investors. Although the withdrawals have abated at many banks, First Republic was apparently in danger, even after receiving a $20 billion infusion of deposits from four major banks in March. The U.S. banking regulator has concluded that the bank's condition has deteriorated, and there's no more time to pursue a rescue mission. The news comes as the Federal Reserve has admitted it failed in its responsibility to take adequate forceful action ahead of the collapse of Silicon Valley Bank last month. In a hard-hitting report released on Friday, the Fed attributed the failures to extremely poor bank management, weakened regulations, and weak government supervision. Undoubtedly, Silicon Valley Bank's collapse has triggered an ongoing banking crisis for mid-sized US banks, and no one knows if we will ever get out of this, because the inability of the Fed to fix and save First Bank from total collapse only worsened the people's fears. The panic amidst the citizens can't be curtailed. Yet, Treasury Secretary Janet L. Yellen and Federal Reserve Chair Jerome H. Powell repeatedly say the other banks in the nation are doing perfectly well. FDIC, which is the major federal regulator for banks, will have to seize First Republic Bank, a once high-flying lender that has been humbled by its inability to adjust to rising interest rates, before selling it to a larger financial institution. As the receiver for a failed bank, the FDIC temporarily manages its affairs and seeks to obtain the greatest value possible for its remaining assets. Also, First Republic shareholders would be wiped out due to the government's takeover and sale plan. In view of this, the FDIC reached out to other financial institutions, including JP Chase, BNC Financial Services, and Bank of America, seeking bids for the First Republic. As part of the bidding process, banks were also asked what parts of the bank they wouldn't accept. So far, JP Chase has emerged as the highest bidder, according to some sources. At this point, it is unclear whether the government will guarantee a refund of all First Republic deposits, including those above the $250,000 per account quota, as it did for the two banks that failed last month. But so far, federal regulators are in defense mode. First Republic had many clients in the startup industry, similar to Silicon Valley Bank, and in the financial industry, including senior bankers and hedge fund managers. Many of its accounts held more than $250,000, the limit for federal deposit insurance. Despite its current state, First Republic remains active to potential bidders. The bank has been profitable every year since its inception in 1985 and has had a lucrative wealth management business which caters to affluent individuals. It is also known for its meticulous loan underwriting. Like the other two failed banks, Silicon Valley Bank and Signature, First Republic collapsed under the weight of loans and investments that lost billions of dollars in value as the Federal Reserve rapidly raised interest rates to fight inflation. When it became apparent that those assets were now worth much less, First Republic's affluent customers, most of whom live on the coasts, began pulling their money out as quickly as they could, and investors dumped its shares. First Republic's collapse could add to concerns about an economic slowdown. The upheaval that began with the failure of Silicon Valley Bank has made banks and investors more cautious, and that caution can make lending more difficult and costly, impeding business expansion and hiring. The seizure of First Republic and its aftermath could also compel the Fed to slow or pause its interest rate increments if it sees it will cause more banks to tighten lending. Last Monday, First Republic revealed that clients had pulled $102 billion in deposits in the first 3 months of the year, well over half the $176 billion it held at the end of 2022. It also said it had borrowed $92 billion, mostly from the Fed and government-backed lending groups, effectively acknowledging that it had to turn to the financial industry's lenders of last resort to keep the doors open. The bank's grim financial statement only fanned the worst fears of investors. Because of the types of clients it served, a large portion of them are multimillionaires, its customer base had little history of defaults. But the bank underwrote mortgages when interest rates were very low and kept them on its books rather than selling them to investors. First Republic's large hoard of home loans lost value every time mortgage rates on new loans increased since last year. You might be wondering, what's causing the banking crisis? Isn't there a way to prevent it? Or will this continue forever? For those who don't understand how the financial system functions, sit back. I will explain in a bit. Firstly, according to experts and analysts in the field, other regional lenders like Utah's Zions Bank and PacWest of Los Angeles have reinforced their footing faster than the First Republic, so bank analysts do not see another collapse coming. The stocks of every other bank in the S&P 500 stock index rose on Friday, even as First Republic shares dropped drastically that same day. It is essential to note that banking crises happen when the financial sector fails to function efficiently, leading to the collapse of one or more financial institutions. There are various causes of banking crisis. It could be economic, financial, or political reasons. However, one of the most common causes of banking crisis is excessive risk-taking by financial institutions. This can occur when banks engage in highly risky investments or loan processes without proper risk management measures in place. In such cases, banks may end up with a sudden loss of confidence from investors, depositors, and other stakeholders. Another factor that can lead to banking crisis is the presence of a large number of non-performing loans, NPLs. When borrowers default on their loans, it can lead to a significant increase in NPLs, which can adversely affect the financial stability of banks. This can cause a ripple effect across the economy, leading to a decline in economic activity and an increase in unemployment. Moreover, macroeconomic factors such as recessions, high inflation, or currency devaluations can cause banking crisis. These factors can negatively impact a bank's financial health, resulting in a decrease in profitability. Finally, regulatory and supervisory failures can also contribute to banking crisis. Weak regulations, inadequate oversight, and a lack of enforcement can encourage risky behavior by banks and allow them to engage in fraudulent activities that can lead to their collapse. With the look of things, we could say that a mix of all these factors was responsible for First Bank's failure. And as such, policymakers and financial institutions need to take measures to prevent or mitigate further crisis, such as improving risk management practices, strengthening regulations, and enhancing supervisory mechanisms. Failure to implement these preventive measures can lead to severe consequences on the economy, including for individuals and business organizations. Bank failures can lead to the loss of personal savings, massive closure of businesses, and layoffs. It can also cause a terrible decline in access to credit, and when credit becomes scarce, it makes it harder for individuals and business owners to obtain loans for any type of project whatsoever. Enjoy the video? Now watch this one.